Welcome to the program on WHEDA Tax Advantage, commonly referred to as Mortgage Credit Certificates or MCCs. Mortgage Credit Certificates were authorized by Congress in 1984. This exclusive program is based on WHEDA's allocation of mortgage revenue bonds. When approved to use a mortgage credit certificate, the borrower reduces their federal income tax liability as long as they meet specific requirements. The value of the MCC is determined as a percentage of the borrower's annual mortgage interest up to a maximum of $2,000. The remaining mortgage interest is applied as an itemized deduction on Schedule A on the buyer's IRS tax return Form 1040. The borrower may continue this credit each year as long as the property is owner-occupied. They file a IRS Form 1040, a Schedule A itemizing deductions for mortgage interest. The maximum MCC credit in any given year is $2,000. The credit amount may not exceed the federal income tax liability. To claim the credit, the borrower files IRS Form 8396, itemizes deductions on Schedule A, and files an IRS Form 1040. In some cases, the borrower may prefer to revise their W-4 withholding statement, reducing their federal tax per pay period. If the borrower does refinance their loan, the tax credit benefit is applied at the same value as originally approved and based on the original loan amount. Financial institutions that participate in WHEDA's single-family loan programs are eligible to offer this program. Each lender completes a WHEDA Tax Advantage MCC agreement. In addition, each loan originator is required to become certified through an approved training program, such as this on-demand webinar. Once the loan originator is certified, their contact information will be included on WHEDA.com in the Find a Lender section. Lenders choosing to advertise for the MCC program must promote the program based on MCC guidelines and follow HUD's Fair Housing Advertising Guidelines. As with other programs offered through WHEDA, there's a compliance income limit based on total household income. This is based on family size and the county in which the property is located. Other compliance guidelines include the borrower being current in child support, birthing expenses, and maintenance as documented through the Wisconsin Child Support Lien Docket. When using the MCC, the property must be owner-occupied as the principal residence for the borrower. Compliance income includes the total income from all adults intending to occupy the home. There is an exclusion for non-recurring income. The calculation for compliance income is taking the current income projected forward 12 months. This should be carefully compared with the previous year's income. Documentation will include current paycheck stubs for the previous 30 days, W-2s for the previous 2 years, and federal tax transcripts or signed tax returns for the previous 2 years. Previous employment verifications are required when the borrower has changed or terminated employment within the previous tax year. All overtime, bonus, commissions, tips, second jobs, seasonal income is always included whether it is guaranteed or not. Child support or other non-taxable income is also included. To assist lenders in compliance income calculation, WHEDA provides a compliance income calculation worksheet, Form 29 in the Forms and Exhibits list, which may be sent to a WHEDA underwriter for review. For this program, WHEDA does not calculate credit qualifying income. To be eligible for an MCC, the borrower must be specific guidelines as a first-time home buyer. Based on the IRS standards, that would be someone who has not owned their principal residence within the previous 3 years. There are 2 exceptions for this guideline. First, a qualified veteran with an honorable discharge and a DD-214, and second is the purchase of a home located within a federally designated target area. The income limits and purchase price limits still apply. These limits can be found on the Single Family Toolkit section of WHEDA.com. WHEDA does require all first-time homebuyers to complete an approved homebuyer education program through a HUD-approved counseling agency, a mortgage insurance provider, or one of the online programs through ehomeamerica.org or frameworkhomeownership.org. Eligible properties may be a single-family home, a 2-unit property, or a condominium. For newly constructed homes, the financing must be the permanent financing on homes that are complete. The IRS has guidelines that include acquisition rehabilitation. The property must be residential with no more than 15% of the area being used for commercial or business purposes. Property that is being used as a 2-unit must be at least 5 years old and owner-occupied. MCCs are available at the time the borrower purchases a home. The loan must be a fixed-rate loan. It may be a WHEDA Advantage loan or other fixed-rate loan offered by a lender. Saying that, mortgages that are amortized for 30 years but are adjustable or balloon mortgages are not eligible. Other ineligible loans include interest-only, home improvement, mortgages financed through the proceeds of a qualified bond or a veteran's mortgage bond, high-cost or high-price mortgages, or financing or interest paid to a person related to the borrower. A borrower should seek tax advice from a tax professional for their specific situation. Many people file an IRS 1040 and a Schedule A itemizing deductions. When using an MCC, the borrower will also file an IRS Form 8396 in addition to the 1040 and Schedule A. The MCC value is a percentage of the mortgage interest that is claimed each year. In Wisconsin, the options are 25% throughout the state, or 40% for properties purchased in a federally designated target area, or the borrower is an eligible veteran. Eligible veterans are those that have an honorable discharge with a DD 214. This slide shows an example of a Schedule A, and it's filed without a mortgage credit certificate or an MCC. The key items on the Schedule A pertaining to the borrower without the MCC are the mortgage interest in the amount of $4,555 and total itemized deductions of $9,859 for this situation. The itemized deduction is carried to IRS Form 1040, page 2, which reduces the adjusted gross income. In this case, we assumed and calculated for a family of 4 prior to calculating the federal tax. The bottom line, the borrower received a $499 refund. Taking the same family and using an MCC in the amount of 25% value, the borrower would take their mortgage interest of $4,555 times the 25% credit value, equaling $1,139. This amount will be carried to Form 1040, page 2, which will reduce their federal interest paid by the same amount of $1,139. The reduction of the mortgage interest leaves a balance of $3,416. This would be applied toward the itemized deductions. The total of itemized deductions that reduces the federal adjusted gross income is now changed to $8,720. The federal tax due is based on these adjustments. As the calculations are completed and the tax is calculated, there is a section for tax credits. In this case, the MCC using Form 8396, there is a check mark in the Other box and a place to fill in the blank with the form number 8396. As you work through the calculations, the MCC amount of $1,139 actually reduces the federal tax liability by the same amount. In this example, the borrower has increased their tax refund to $1,465. Many people purchasing homes have the option to itemize deductions. Itemized deductions on Schedule A include categories for medical, state, local sales or property taxes, mortgage interest, charitable contributions, some losses or other expenses. Again, the borrower should seek the advice of a tax professional for their situation. There may be a few people that will use the standard deduction. This amount is set annually by the IRS, so looking at the year 2014, that amount would be $6,200 for a single person or $12,400 for a married couple filing jointly. To provide an idea of what interest may be in any given year, the example shows various amounts assuming a 4% interest rate. Even with the loan amount at $100,000, the borrower with the 25% MCC credit saves $910 in federal taxes. At a loan amount of $140,000, the borrower with a 40% MCC credit has already reached the maximum of $2,000. Using the loan amount of $140,000, assuming a 4% interest rate, the MCC at 25% saves a borrower approximately $106 per month. At the 40% credit, the savings is roughly $166 per month. If needed, this amount may be added to the borrower's monthly income for both qualifying and compliance to help a borrower meet the debt-to-income guidelines within a given fixed-rate program. The process to obtain a mortgage credit certificate, the lender will determine the initial eligibility and the borrower will need to complete homebuyer education. The lender provides documentation as shown on the Reservation Package Checklist, MCC Form 1, to WHEDA for a decision. Once WHEDA approves the commitment, the lender should close the loan within 90 days. If for some reason the loan does not close or the MCC request is canceled, the lender should cancel the MCC commitment with WHEDA. The cost for the MCC must be disclosed to the borrower. At the time of closing, the lender would collect the $150 if the MCC is used in conjunction with a WHEDA Advantage loan, or $600 if the MCC is used with another fixed-rate loan product. After closing, the lender will send the closing package to WHEDA. Let's step back to the reservation package related to compliance underwriting. The information provided is for income, household size, purchase price, financing provided, and a few WHEDA forms. One of the forms is an acknowledgement of federal recapture tax. Details for the federal recapture tax are provided on a separate on-demand training on WHEDA's toolkit. The closing package checklist is sent to WHEDA within 10 days of closing. The items pertaining to a closing include a seller's affidavit, which may be signed at any time in the loan process or at closing. After closing, the lender sends the closing package to WHEDA within 10 days, and staff will review the documentation. When used in conjunction with a WHEDA loan, WHEDA deducts the $150 fee at the time we purchase the loan. When used with a non-WHEDA loan, the lender sends the check for $600 along with the closing package. Once reviewed, WHEDA staff will send the certificate directly to the borrower along with a copy to the originating lender. There are 10 forms available for the MCC program, plus 2 exhibits. The 10th form is the participation agreement. Forms include a request for conditional commitment, similar to a borrower's affidavit, a recapture notice, a lender's affidavit, a seller's affidavit, and a closing affidavit. One of the exhibits is a tax credit worksheet to assist lenders in determining eligibility. The IRS Form 8828 provides details that would be used if the borrower ever had to pay a recapture tax. This would be filed with their tax return in the year they sell their home. Historically, very few people have ever paid the recapture tax. Recapture tax may apply only if 3 things occur. First, the borrower sells the home within 9 years. Second, the borrower's adjusted gross income increases substantially in the year of the sale. And third, the borrower has a capital gain on the sale of the home. All 3 items must occur, and if applicable, the borrower pays the lowest amount of the calculations. WHEDA does provide a guarantee to reimburse a borrower in the rare event that they are subject to recapture tax. After filing their tax return, the borrower would request reimbursement. For borrowers using a fixed-rate finance product through another source, the guarantee does not apply. The borrower is responsible for filing their tax returns with all forms to claim the MCC. They would calculate the value of their annual credit based on the mortgage interest times the credit value of either 25% or 40%. This will reduce their federal tax liability not to exceed $2,000 in any given year. For more information, the IRS Publication 530, Tax Information for First-Time Homeowners, and IRS Form 8828 with their instructions for recapture tax are available on the IRS website. The borrower has the option to adjust their W-4 withholding statement to have savings per paycheck. The MCC revocation occurs when the property is no longer owner-occupied as a primary residence. Other ways the MCC revocation may occur is if the borrower does not meet the qualifying requirements or if there is discovery of material misstatement or the borrower fails to notify WHEDA within 1 year from the date of a refinance. In the event of a refinance, the borrower notifies WHEDA within that 1 year asking to reissue their certificate. At least one borrower must remain on the loan and in the property. There's a $300 charge to WHEDA, and when refinancing, the replacement of the original MCC is based on the original mortgage and date, the original balance of the loan, which does decrease, and in the same credit value of 25% or 40%. Lenders have an annual reporting requirement. In January of each year, WHEDA will provide the lender with a list of borrowers who received an MCC through their organization in the previous year. The lender, in turn, will complete an IRS Form 8329 noting in the Lenders section, issuing authority as WHEDA, the recipient's name and address and the date of the MCC, the loan amount, the MCC credit, and the certificate value. The lender will provide WHEDA a copy of this form that they send to the IRS. Document retention for this form is 6 years. For lenders using a WHEDA FHA as a sponsored originator, WHEDA is responsible for completing the IRS Form 8329. Thank you for joining us in the program for mortgage credit certificates. If you have questions, please contact us at 800-334-6873 or email at underwriting@wheda.com.